Hello everyone, and welcome back to the channel 5 to 9 Real Estate, where we teach you how to use your 9 to 5 income to invest and make money in your 5 to 9. So today I'm going to be talking about refinancing and why this is one of the best kept secrets for real estate investing, and frankly, a big strategy that we've used to build our wealth in real estate. So I'm actually going to be walking through an example. This was actually one of our properties in the timelines for being able to take money back out of the property. So basically, when you first buy a property, typically people have financing on the mortgage, right? And so even if you're at the end of your mortgage term, so let's say if you get a 3-year or a 5-year term, you're already going to have to refinance the property to get new financing on it. And this might seem really obvious in terms of, refinancing, but it's actually a really powerful tool for being able to take money back out of the property that you've accumulated in equity. So I've actually prepared an example here. It's a breakdown of one of our own personal properties and the way that we've been able to refinance it and get the equity out of the property. Okay, so I'm going to be sharing my screen now, and I'm going to be walking us through the process of purchasing a property and when it would make sense to refinance and what that process looks like. So basically on my screen here, you can see that in finance, an asset is defined as liability and equity. So I've actually broken down here in terms of what the property value of the property is and the breakdown of the mortgage and the equity. So just to actually break this down for you. So this property was purchased in 2015 for $471,500, and in this case, because it was under $500,000, I was able to put in a much smaller down payment. But because of not putting in 20%, I did have to get mortgage default insurance on the property. So I've done other videos on that, and I'll make sure I reference them in this one. But that's the reason for the down payment was $23,575. But CMHC insurance, the mortgage default insurance, was actually $17,917. So that's essentially added to your mortgage amount. And so this means that the actual original equity in the property was actually only about $5,500. So that is a huge chunk out in the beginning. So something to be aware of if you're putting a smaller amount of money on a property and then looking to refinance it later, be prepared that you already have that sunk cost of the mortgage default insurance. With this, basically the mortgage overall in this case was $465,842. Now, this is going to be the next key thing, is looking at this refinance, and it'll become clear in terms of why this is so powerful. But basically, in short, assuming that you get the appraisal that you're looking for and your income ratio supported, in most cases, you're able to loan up to 80% loan to value of a property with residential mortgages. So the reason why this is so powerful is because if it makes sense with a particular property, with the increased equity that you have, you're actually able to dip into that. By refinancing, you're actually taking money out. So I'll show you what I mean by this, but I wanted to go over that quickly. So in 2018, the property was actually appraised at $675,000. So, and at that time, the mortgage paydown had paid down to $430,372.29. So this means that we've actually grown the equity in the property by $244,627.71. So this is what I mean, and I'm just going to scroll up here so you can see, as we've been paying down the mortgage and as there's been market appreciation, our equity has grown. So how do we get into that so that we can, leverage it to invest in other properties, basically? So what we're going to do here is, like I'd mentioned before, in this case, we did qualify to take out 80% loan to value of the property. And because it was appraised at $675,000, that means that the new mortgage that we can take out is $540,000. So this means that essentially what we're going to do is we're going to subtract this new mortgage by the existing mortgage that's already on the property. And then the difference between the 20% that has to remain on the property and the old mortgage is the amount of money that you can actually unlock from that property. So, to recap, basically the new mortgage subtract the old mortgage is the leftover equity that we can take out. So in this case, it's just shy of $110,000. A couple other things that you can do to help in the situation to try to optimize the amount of money you can take out is you can buy it under market value, you can do some renovations, you can get new or higher rental income, and also if you accelerate your mortgage pay down. These are all things that are, obviously going to increase the equity that you have here and make it easier to take out the difference between the 20% that you have to have on the property for your refinance and the previous mortgage. So the next thing to note is that there are a couple of caveats to this strategy. The first one, like I mentioned before, is that your property does need to appraise at that value. So let's say if I thought that the property was worth $675, but it was actually worth $650, then obviously that's going to impact how much I can take out of the property. Another thing to be aware of is that your income ratios do have to support your new mortgage. And it's important to work with a mortgage broker while you're doing this. They'll be able to advise you in terms of, what kind of strategies you can use or maybe some other options. But it's important to work with them because not all income is considered the same from the banks. For self-employment income, they're going to take 2-year averages. For those who have a base salary, but then you've got any other incentives on top of that, like commission or year-end bonuses or anything like that, they're only going to take your base salary until they can take 2 years of income for the rest of your income. So just be aware of that because you don't want to have any surprises. And also, I hope that this goes without saying, but if you're going to have a higher mortgage on the property, you're going to have more debt on the property and you're going to have higher expenses. So just be prepared for that in your new financial reality, that's not going to hurt you anywhere else in your portfolio. At the end of the day, obviously I've just done this for educational purposes. This is actually an example that we did ourselves with our personal property. So I'm just sharing it so other people can learn from that, but really do your own due diligence and make sure that you understand all the pros and cons, risks, potential rewards, and that you're making the best decision for yourself. And if I may, I just don't want to give anyone the wrong idea. So I'm going to give you some examples of why I don't think you should do this. So if you are looking to get into the equity to pay for luxury items that you can't pay for out of pocket, would highly suggest that you don't do that. This is a big part of the reason why, a strategy like this is essentially what caused the housing crisis in the States during the last housing crisis. So if you're taking out this money, like the $110,000, let's just round up, to go and buy a boat or, a cottage that you're not going to rent out and earn any income from, or you want to put it into the, Dogecoin or something a little bit, that's kind of some kind of fad right now. I'll park that conversation for maybe another video. But just don't put yourself in a risky situation. If you have the money to pay out of pocket to go and buy that cottage and you can pay for the monthly cost of owning that, that's fantastic. All the power to you, but I'd hate to see people dipping into basically, kind of a locked savings account in a way to pay for things that are just a little bit out of grasp, because ultimately if something does happen with the market and there's a dip, be prepared that your equity is going to go down, right? So if it dips more than 20%, you have to make sure that you have that accounted for somewhere. Otherwise, you're going to sink yourselves. So just, want to make sure that people are aware of that and taking that point very seriously. And the other point that I'd bring up is I would ideally not do this on a property that you're not earning any income from. Because again, part of the reason why in this case it's worth it for us, and this particular property I did live in and I was house hacking, so I was still earning income, and then I actually moved from this property and then I was renting the full property out. So I would recommend that, they're earning income on the property as well, because again, it's kind of hedging against the fact that you're taking money out of it to do other things with it. So those are my ideas for today that I wanted to share with everyone. I hope that you see the value in this as well. It's been a fantastic strategy for us to basically recycle our money into other future properties. And another big benefit that I'll mention about the refinance is that this is a really powerful way to be able to defer your capital gains. So whenever you sell a property, if it's not your personal primary residence, we do have to pay capital gains on that. So this is actually a way, I actually prefer this as opposed to flipping a property, because then you are recognizing those losses in taxes. When you do the refinance, there's no capital gains you have to pay. Again, just double check with your accountant for your specific situation. If you are renting out like a personal part of the property, but making income on other parts and then you move out of it, there could be some tax triggering there. But I'm going to leave that for you to talk about with your accountant to make sure you're protected from that perspective. But ultimately, yeah, for us personally, this has been the best way to be able to get our money out without getting dinged with taxes, to be able to recycle it to put into other projects. So I hope you enjoyed the video today. The next video I'll be doing is actually talking about the difference between just completely refinancing the property and bringing it up to 80% loan to value compared to opening up a HELOC or home equity line of credit. So stay tuned for that next video. If you enjoyed the content today, please give me the thumbs up, subscribe to the channel. If you have any additional questions, please leave them below and I will be happy to do future videos on that. All right, thanks so much guys, and see you next time.